welcome to the firm. On the show this week, ROFRs, drag and tag rights and call and put options. They all get SEBI's stamp of approval. But every silver lining comes with a cloud. States win, developers lose, and we may have a new definition of works contract. The good news is that earlier this week, SEBI notified that contracts for preemption rights, including ROFRs, contracts for drag and tag-along rights, and call and put options are permitted in shareholder agreements and articles of association. The not-so-good news? This is prospective. Nonetheless, this is a big positive development for joint ventures and private equity investments, both of which are often accompanied by such rights and options. But as I said, every silver lining comes with a cloud. So we don't know yet if RBI will play ball with this. To talk about this issue, I'm joined today by Ashwath of Amarchand and Punit Shah of KPMG. Gentlemen, to both of you, a warm welcome. Let me start first by talking about the conditionalities imposed on call and put options by SEBI in its October 3rd notification. A minimum holding period of 1 year after the contract is entered into, the price to be in compliance with all laws, and the contract to be settled by actual delivery of underlying securities. The first and third, Ashwath, seem to me to be rather benign. The price bit, are they referring to a specific provision, or is this just an umbrella provision?
FEMA guidelines, which refer you back in certain cases to SEBI regulations as well. So price has to comply with whatever requirements apply to pricing, effectively.
So DCF and SEBI, those are the only two methodologies as of now.
So
everything that's in the October 3rd notification seems clear, seems above board, seems easy to understand, and the conditions are benign. Do you both agree on that?
Absolutely.
I think it makes complete sense. It's very positive.
So the only question now is that several of such call and put options that came with fixed returns and fixed prices and therefore were in a sense debt masquerading as equity, they were objected to by RBI, and the question stands whether RBI will now permit these to go through, or will they have their own set of conditions that applies. Ashwath, how do you read this in terms of the RBI question mark that's still open?
I think if you look at the SEBI notification, clearly I agree with Punit, as a positive step. It is entirely conditional upon FEMA. So lot remains to be seen in relation to what RBI now does.
Right.
If you look at it from a health business perspective, I think it will be great if the RBI now comes out and actually articulates, whatever the conditions may be, articulates the circumstances in which it as the exchange control regulator will have a problem with any of these options. Now, historically, those have been in the context of the fact that many of those options were for fixed returns, right? And consequently, it was believed that there was no equity risk really that was there. Because there was no equity risk, it was effectively foreign investment, which was actually an ECB, in violation of the ECB norms. Now, one simple way of the RBI possibly addressing that concern is to turn around and say that any valuation has to be linked to the fair market value of the company at the time the option is exercised, and say that as long as that condition and the pricing guidelines are met, it's a valid option, and that will clear a lot of the problems that are there. But from a private equity perspective, the one problem that I still see subsisting is private equity investors typically have these put options as a last resort. They really don't want to sell back to the promoter. They want an IPO exit, they want a strategic exit, they want many kinds of exits, and typically it says, the agreements would say that if for 5 years I don't get an exit, right, then you as the promoter will buy me out, right? Given that the valuation is typically done on terms that are dictated by the promoter, one of the understandings which is commercial common all over the world is to basically say that I as the private equity investor will go out at fair market value provided that there is a minimum.
So now, I need some price protection.
I need some price protection. And if the notification basically says any kind of fixed return is ECB, even a minimum floor that is prescribed, which is commercially required,
will not be kosher according to the RBI.
Will be invalid effect.
There has always been a controversy in terms of if the formula pricing is provided in the contract. In that case, whether that is considered to be a fixed return or not, that always been a matter of debate. And I'm not sure how RBI is going to deal with that situation, because there's a fixed price, and therefore there's a fixed return, and therefore there's ECB, and therefore put call option is invalid. Now there's a formula pricing, which again leads to a particular return or a fixed return. Now how they are going to deal with that, that's going to be a big
any
challenge.
formula pricing which has DCF in it DCF can be manipulated. We know RBI has not prescribed any specific methods for DCF when it comes to unlisted.
That's correct.
So you can still arrive at a protected price, so to speak.
Exactly. That's the point I'm making. And therefore, whether RBI
But then you're part of that group of people that,
That's right.
I don't know.
And therefore, if RBI takes a negative view of that, in that case...
So there should be no formula, there should be no price protection, there should be nothing. That's possibly the only grounds on which the RBI will approve of this.
That's correct. That could become a big challenge to my mind.
So we need to see the wording of what RBI puts out, and I understand that there is going to be a notification because RBI has been part of these consultations, which, as we know, have been going on for 2 years with the Finance Ministry on how to clear the road for call and put options.
I think that's going to be very, very critical, because two regulators talking to each other is something which we have found to be very rare.
Look, they referred to FEMA in this, so I'm sure RBI is on board, and I'm sure what we'll get from RBI will be just as sensible as this.
And from a foreign investment point of view, this notification has to be followed up from clarity from the RBI for it to be meaningful. Otherwise,
absolutely. Otherwise, you are back to square one.
Where you are.
Cool. So we'll be waiting to hear what the RBI says, and hopefully they will allow for some degree of price protection, but not a fixed return, so to speak.
That's right.
But even if they don't allow either, at least the bulk of the transaction should be safe. Let me come to the issue of what the Companies Act 2013 allows and doesn't allow, right? They have allowed free transferability, but they have also said that you can, between two parties, have a contract or an arrangement that is in respect of transfer of securities, and this shall be enforceable as a contract. I'm just curious to know whether this whole issue of call and put options, when it comes to both public listed as well as public unlisted companies, does it have any implications in terms of being embedded in the Articles of Association or not?
The approach, going forward, I think will still be to put it in the articles. There are challenges, but people would still try and put it into articles.
But then wouldn't you be violative of 58, which says they should be freely transferred?
But 58 too now has a proviso. I think the new act goes a long way towards giving you comfort on enforceability of preemption rights. But it uses the word enforceable, and enforceable has two meanings. One is enforceable in specific performance, enforceable in damages, right? Insofar as enforceable in specific performance, it means that if you transfer in violation, somebody should be able to injunct the transfer, right? Now, if it is not going to be there in the articles, whether a court will injunct, because there's no constructive notice to the buyer, is a big question mark. So that's why I said, irrespective of how this pans out, I think this issue will have to be decided in the context of is enforceable both in specific performance and damages, or is it only damages? Because if the outcome of this interpretation ultimately when it goes to the Supreme Court is that it is only going to be in damages, I'm not sure what value it's going to be it's not going to be adding too much value, because it's spilt milk. Damages is not going to be adequate remedy. Today in the context of any partnership, strategic or private equity,
absolutely,
the key is to injunct and prevent the transfer. So you will definitely try and put it into the articles and try and fight it out on that basis. But even if it is in the articles, there's no guarantee that it will be injuncted. It's just that you have a better case for it.
So, Manya, just to add, I think you are absolutely right. There seems to be a contradiction within Companies
so
Act.
If you agree with him, Punit, let me put my question this way.
Yes.
Given Companies Act 2013, given the October 3rd notification by SEBI, what would you recommend companies do when they are in such a position where, let's say, the promoter shareholder has decided or contracted a ROFR or some form of call and put option with another investor in that company? Would you suggest that ROFR or call and put option be put into the Articles of Association for that contract to be enforceable, or are you saying it doesn't matter whether it's in the articles or not?
I would say it has to be in the Articles of Association, because there is no downside.
And you don't see that violating the main body of 58?
It could violate, and I don't think there is an answer to that, Minka.
In a worst case scenario,
because it cannot harm you.
It cannot harm you. Right? Enforceability doesn't happen in any event in terms of injunction.
So if you look at
what's the downside?
That's correct. If you look at the old Supreme Court ruling, which clearly said that any provision between two shareholders is enforceable only if it is put into Articles of Association. Now that was in the context of a private company, but I'm sure that principle applies even for an unlisted public company in that sense, and therefore you may not have any option but to put it in the Articles of Association, even though it may prima facie contradict to the main provision, which is section 58.
So that's still an open question that needs to be tested in the Supreme Court.
But again, preemption, Menka, Companies Act with this net positive, but the problem is in respect of options, where you have section 194, which is a prohibition on forward dealing, which basically says directors and key managerial personnel can't get into put and call options. Now if you look at any strategic or private equity transaction, more often than not, the party to the put or the call typically tends to be the promoter.
And that's because the put can't be on the company, otherwise it would interfere with buyback regulations, especially in the listed case.
Which are anyway specific regulations that should override.
So it's a put given to the promoter. The promoter is either at least a director, if not a chairman or a managing director.
So how do you reconcile the two? Because now 194 says you can't do that forward contract.
And that's a complication, and since there's imprisonment involved, one will have to look at how we solve that problem. One immediate problem that we were discussing is really the possibility of a promoter company providing that particular offer.
Well, look, again, that has to be tested, right? Because look, let's see, I know that you mentioned earlier in our conversations that we were having that 194 has more to do with insider trading. But then that would mean that if the promoter can't, forget the call and put options, if the promoter cannot undertake any forward contracts, but the promoter's holding company can undertake forward contracts, then the whole anti-insider trading bit is also killed. So let's be honest, 194 could also extend to promoters holding companies. Just because the word director of a company or any of its KMP is used here, that doesn't mean the director's company is ruled out.
Minka, as I said, this is a section which has criminal liability, right? Yeah. This is going to require consideration. Yeah, and I mean, one has to see what the MCA's view on it is well, because at the end of the day, given the risk involved in this, I don't know how many people are going to be willing to take an aggressive position with the consequences being what they are. So this is
some brave person has to tell.
This does create grayness, which is why I said net positive on preemption, but as far as options are concerned, whilst it's very helpful on a standalone basis, how much practical impact it's going to have is also going to depend on how we read 194, because in reality, who are the parties to these options?
Okay, so we've raised 3 questions. What will RBI say in its accompanying notification on this? How will the embedding of call and put options or any other kinds of preemption rights in the Articles of Association pan out? And then we've said, how will Section 194 of the New Companies Act work and reconcile the placing of a put on a promoter as versus a promoter's company, so to speak? I'm curious to know whether, besides the answers to these 3 questions, would you all be awaiting anything else here onwards to be able to include call and put options, tag along, drag along, ROFRs in shareholder agreements and AOAs, or is the door wide open now?
As the securities regulator, I think the reality is they've done as much as they could have done. And I think full marks to them in terms of how this notification has been sort of drafted, because there was a lot of concern earlier in relation to whether there would be many caveats and many classes of transactions would be left.
Intention seems to be very clear. I mean, if at all there is a contradiction because of Companies Act and not because of the SEBI notification. That's how I would put it.
So your firm is in the middle of a couple of big transactions. Let me ask you this question, Ashwath. Starting today, will you be putting call and put options into not necessarily those transactions, but all transactions that you deal with, either private equity or joint venture?
I think that's the one thing we left out, Menka. The one problem with this particular notification, if one were to identify one problem with the notification itself, is the fact that it is not retrospective, right?
Yes, but so you're not really expecting it to be retrospective.
I mean, at the end of the day, given the objective, which is to ultimately facilitate business, and if you're recognizing the fact that there's nothing illegal about these kind of transactions prospectively.
Look, it was not allowed till now. SEBI itself has asked many companies, or in many transactions asked companies to stay away from this. They could not now say, look, we've told many companies to stay away from this, but if you've gone ahead and done it, we'll validate it, retrospectively. There was no way they could have made it retrospectively valid. There was no question. I mean, I know you're disappointed, but there's no way they could have done it. You should be happy that it's prospective and you have the opportunity to renegotiate these clauses into some agreement.
And that's where one constraint comes up, which is if there's mutual agreement, right, you're absolutely right, we can enter into those options today, and we would do that wherever it's possible. But I'm not quite sure what percentile those cases are going to be, because if, things were all that hunky-dory, the litigation profession would not have a business, and how many counterparties who are going to be the subject matter of obligations under these options are going to be willing to enter into fresh contracts remains to be seen.
All the call and put options that you put into agreements so far, you put knowing fully well that they may not stand up in a court of law because of all the question marks around it. Here onwards, you can put them in agreements knowing at least that they will stand up in a court of law subject to some of the unanswered questions, right?
Which is why I said very positive. I wish it could have covered, existing arrangements, but I'll take the prospective.
Yeah, well, if wishes were horses, lawyers would fly.
I think you can always put it in the existing agreement. You can try and do addendums. You can try and provide some.
Punit is looking forward to a lot of agreements coming back to him for renegotiation.
Absolutely. I'm sure that's the way to look at the law.
The food chain keeps turning, like they say. Gentlemen, thank you so much. I know we're still awaiting some answers on this, but this clearly is a big, fat, thick silver lining with a small grey cloud at the center. Ashwath, Punit, thanks very much for joining us on The Firm. With that, we're going to take a quick break. On the other side, states win, developers lose, and we may have a new definition of works contract.